In this third and final video, we're going to talk about the brutal elements of this law. If you haven't seen those first videos, I would recommend you go back and watch those first before we go through these brutal elements. Now, what are some of the brutal things in this law? Number one, the expiration of the clean energy tax credits, including the $7,500 clean energy tax credit for electric vehicles. Why is this brutal? Well, we all know that we have an energy shortage here in the United States, right? We are trying to build data centers, and increasingly our energy prices keep going up and up and up. Now, we've been told we need to drill, baby, drill. We need to go out there and get more oil, more natural gas. But the sad truth of it is, and most of us that are investors know this, the lowest cost of energy production today in the United States is wind and solar. The cost curve on solar has been coming down so much that if most people look at solar, it is by far their most efficient thing that they could do. Also, we're in this massive transition from internal combustion engines, which are essentially had 100 years of innovation, to electric engines, which are brand new and are already more efficient than these gas-powered engines that they're replacing. To essentially say, well, we're going to not incentivize this anymore, we think is a brutal element of this law. The $7,500 clean energy tax credit for an electric vehicle goes away entirely. For any of you that were doing any type of repairs to your house, like a new, maybe high efficiency furnace that basically could heat your house for maybe 2/3 of the price, or maybe putting solar panels on your roof so that you could be off grid and not be reliant on the energy company, or getting a battery backup. Historically, 30% of that would have come back to you if you were making these energy improvements. Now they're all essentially being phased out and they're going away. We think that that's brutal. We're actually going backwards in time now, and we're essentially saying we don't want this clean energy future. We'd rather go out there and drill, baby, drill, instead of doing the things that we know are going to be cheaper, better for the environment, and long-term more sustainable for our country. Number two, and this has gotten a lot of press, the car interest loan deduction is a brutal element of this law. Now, on the face of it, when you look at it, who wouldn't like to deduct their interest on their car loan, right? Car loan interest can really add up over time, and especially with rates being as high as they are, people love the idea of, well, if I buy a US made car, I get to deduct that interest. But here's what makes this part brutal. The deduction amount is basically based on your income. And if your income exceeds $100,000 for an individual, or $200,000, you start to lose that deduction. The car can only be made for personal use. So if you use your car for business, or it's a fleet car like an Uber, right, can't deduct it. Finally, if the car isn't assembled in the United States, let's say it's made in Mexico or Canada, it doesn't qualify. So a lot of cars that people want to buy are not going to qualify for this. The last part of this is that it's brutal because it ends in 2028. So now we have this very temporary nature of this deduction of interest. If I buy a new car today, let's say my income is low enough to where I can qualify for the interest deduction. Let's say that somehow my car has a VIN number that was assembled in the United States and it qualifies under this act. But I get a 6-year loan. After the next 3 years, there's a ton of uncertainty around what this will be. And it actually sunsets in 3 years. And we think that that's brutal. Now people are trying to plan for this car. They're trying to decide, should I get the car? How much will the interest save me? But the reality is, at the end of the 3 years, it's all kind of up in the air and it kind of goes away. Third, the SALT deduction. Now, the SALT is the state and local income tax deduction. As you can imagine, under the Tax Cuts and Jobs Act, one of the criticisms was, hey, you did give us this bigger standard deduction, but we lost all the deductions on our state and local income taxes. And for a lot of high cost states like California, for example, where their state tax is quite high and they might also have high property taxes because it's a high cost state, they were losing out on, in many cases, tens of thousands of dollars in otherwise deductions that they would have been able to claim. So under this new One Big Beautiful Bill Act, the SALT deduction was increased from $10,000 to $40,000. Now that initially looks fantastic until you look under the hood for a second. That increase was temporary, meaning it's only for the next 3 years. Last, it's only possible to take the SALT deduction if you itemize. So even though you might have, let's say, this massive standard deduction that we just talked about in the previous video as beautiful because it reduces complexity, now if you want to try to take the SALT deduction, you have to go back to itemizing, which now increases your complexity again. The SALT deduction, which initially looks like this great gift, most people will not benefit from the SALT deduction. If you're in a low income state like Florida or Texas, where basically there's little to no income tax and maybe your property taxes are very low, you're not going to benefit from this. So those are the three brutal elements of this law. If you ever have questions on how these laws affect you, how they will affect your financial planning, feel free to call us here at Verde. We love talking about this stuff. It's our passion. You've got the number in the description. Also, feel free to comment, like, or subscribe to our channel for more of these types of videos. We drop a new video every Wednesday, so stay tuned for those.